Hey, Lindsay Davis, what you got going on over there in New York?
Not too much, Jason. I am fresh out of quarantining and I have tested negative for COVID. So I'm going to be enjoying a nice long run in this beautiful 40-degree weather.
Congratulations and thank you for quarantining and not being a source of a major spreader event. You, I was thinking on one of my long runs, what's the biggest fintech you know?
The DTCC,
Uh, maybe. What's the biggest you could think of?
Bitcoin.
Bigger.
Um, hmm.
Hint, they had a major outage last month.
Well, that could describe a couple of companies that we know.
Okay. Yeah, not Robinhood. Bigger than Robinhood.
Well, I think then in that scenario, you would be talking about the Federal Reserve.
The Federal Reserve. How often do we actually talk about the Federal Reserve and the fact that it is probably the biggest fintech in the entire world?
Well, not nearly enough, and it doesn't get enough credit. When it does go out, though, the world certainly knows because the world stops. And it's such a big fundamental part of the ecosystem that I sent out that tweet. The Fed is really a fintech.
The Fed is really a fintech, which got me thinking about the Fed is really a fintech and just how pervasive it is. Now, in my 20 plus years of being in financial services and fintech, I don't know that I ever remember it going out this completely. Like I remember like the wires being down for a little bit, but never seeing account services down and central bank down and check 21. Like it was all down, right? And not for a little bit of time, but like for hours. And when you think about the volume the Fed does, we're talking about like quickly billions and then approaching trillions of
Certainly.
dollars being hung up.
But to their credit, they got it back up within the same day. And it was ultimately the source of a manual human error, which then brings the bigger question as to, why are we certainly doing some things still manually? And that's what fintech was really brought to market to fix and automate. And across the scope, you work with banks, you understand that and you see it. It's inefficient, but now it's really created issues in getting people paid, frankly. And that's one of the most important jobs that the Federal Reserve
Yeah,
process.
the direct deposit being down does not help. And the ripple effect then of people dependent on checks coming in because they have automated things going out. But I think that's also another thing to look at is when you fully connect this much of the world, the unintended consequences of what can happen quickly when that automation, right? Like this is why we learned on the trading side of, hey, things can spiral out of control really quickly. Putting stops in the market, is an important thing to level set. To say, hey, if the algorithms run amok, or hey, did Lindsay not really intend to have 20 different bill pays go out when there's $0, in her account because she didn't get paid?
I could unpack a lot of those issues for you. And I think the most important part there is taking a step back and thinking through, if something does break, what is the biggest ripple effect? Like, what is the number one job that needs to get done? And what is the contingency plan here? And I think the trading, you had you had a risk mitigation lever get pulled as a result of high volatility in the market, and that was as a result of a previous crisis. So some of the margin that was required in that scenario was ultimately put in place because of a bigger issue that happened, which was the financial crisis. But for consumers in a scenario where you're getting paid, you certainly need to have a better route to get access to funds. And I'm on this. I personally believe that people should be able to get paid daily, and not being able to access your funds is something that we work on at Atomic. But broadly, I think that everyone cares deeply about because it fuels, like you said, the day to day paying bills. Making it paycheck to paycheck is not a scenario where the Fed can be down.
Well, and I think this is when I started thinking about the Fed as a fintech, and it's like, oh yeah, but it's been at it an awful long time. One of the things that got me thinking is how hard it is when you have two different systems that run at very different speeds. And we've kind of been faking it till we could make it within banking for a while, right? Which is we used to do batch processing at night for everything to kind of settle in the huge mainframes. And then it's like, oh man, now, online and heaven forbid mobile banking comes along. We needed to come up with a proxy. So let's hold something in the middle layer up here so that, we can approximate a real time, right? And the Fed's a perfect example of this, of what happens when, and what can go wrong when you have one system that runs at one speed and is hardwired one way, and we're building entirely new things over here on the other that, their clock speed set to something entirely different, and the way they
Right.
operate is entirely different. Now they connect, but when one doesn't kind of function the way you'd expect, it becomes a problem.
And it's really interesting, as you said, that it brings parallels to the way that bank cores are spun up. The path of least resistance, which is the most expensive, is to run both in tandem. So you've got the one that's still running, but rip and replace is not the way that the financial services thinks about technology. I think because the term rip and replace sounds pretty treacherous, and the least amount of risk is typically the way that the industry moves. Even DTCC, when we were moving from T+3 to T+2, T0 in real time were options. The banks that sit on DTCC's board, because it's a market utility, voted for T2 because of literally a manual human error. That could happen, and it did, and it bankrupted effectively Knight Capital my first week at the company when I came out of school. But
no wonder you're so scarred. There's a little PTSD related to, fintech outages.
To some degree, but I think it's given me lessons in historical knowledge to pull back. And it, when we think about why are there two things built this way, you have to understand that contextual history to fix it, right? And that's what we're all just here to do.
Well, and you hit one of the other major challenges, this idea of rip and replace not being an option. Although historically banks have thought of, core conversions, it is a kind of week-long band-aid, typically over a weekend, when you do the cutover and, figure out what didn't work properly. But it does say, do we need to fundamentally rethink some of the ways we integrate and function? And I think it isn't just the technology. I think the contracts to make some of these partnerships work need to be fundamentally changed. And it's not just the legacy cores that I'm picking on that want a 5 to 7 year contract with, all kinds of exclusivity and these other things, because I see just as many startups in fintech want that certainty, right? And so the question becomes, how do we begin to move to the fractionalized world that we've started to get used to, in so many other regards, right? Where I can, buy my minutes kind of spontaneously if that's what my wireless plan looks like, or I only pay for the apps I use, not, the full suite.
Right, the on-demand model as well, getting real-time access to do those types of things. I think it starts with the need, and it does start with the culture too. You and I think this way and we're aligned, but to get us to go work for a bank right now might be, we work with them and in the ecosystem and around, but to go back to a bank and to fight that culture internally, be the one, champion of that, is really tricky. And I think that it's frustrating to want those things, and the bank needs those things. And I think that there's alignment there, but you have to have, it's an entire culture shift. You really have to shift the mindset of, and that happened during COVID with certain services and products. Like they had no choice when they lost their branches. They had to implement account onboarding and digital and remote authentication tools as a result of knowing that they couldn't service their customers, the increased risk of fraud, and the fact that, you can't acquire deposits anymore. You have to make these things seamless for the consumer. Otherwise, they will churn, and they did, and they had tons of other options. And we saw that in the volumes of account openings at various different companies across the board.
Well, and it raises the question architecturally. I think of Angela Strange's blog post after they led the Series A in Move, where she described, going from kind of the full stack to the layer cake, to thinking of, the moves of the world are breaking it into Legos, right? Microservices that serve these things. If that isn't, really, not just because we're big fans of Wade and Move, but we'll just call this the Wade Arnold fan club episode. But, the idea is that how you actually begin to de-risk some of these moves, right? If it's in microservices, that didn't mean to call it moves, but if I break it up into microservices versus thinking rip and replace, because with Fed now on the horizon, this idea of faster payments, that's a bit of a rip and replace, of sorts. How much risk are we putting into the system? Do we need to rethink our overall approach?
In this specific scenario, you look globally, it's a joke that we don't have real-time payments. Again, something that Europe has had for a decade. The fact that over 940 million checks were sent in Q3 2020 in the mail to people worth roughly $2 trillion, that is a joke. I mean, the rest of the world doesn't potentially know what a check is, and they might see them as a B2B tool, but they don't use them as a consumer payments tool, a consumer's wages tool. And the sad thing is, the fact that we are sub 1 billion checks in the mail was a celebrated thing.
Yes. Well, remember, I cut my teeth. You started at Knight Capital. I was at Deluxe Corporation, the check printer, in the early 90s when, the talk was the internet is happening and no more checks are going to be printed. Well,
right.
They still have a pretty healthy business, unfortunately.
I think as a contingency, I guess it's somewhat necessary. I can think of lots of other contingencies to pay people. And it's something that I think about deeply as we think about how do you get the paycheck to people in an efficient, consistent manner and an entrusted way, right? If these things break, then the consumer loses trust. And it's never a scenario where we end up seeing these micro things get implemented and have real time, benefits for all of us. But it's breaking the problem up by like, what is the biggest pain? And I think that that's the way that Wade has built his business. It's the way we were building ours. We have experience in building fintech companies for financial services firms, and we just see where the pain is. And in using that knowledge and that context again is the way that you can at least get to market and start to test and solve for the ways in which the banks are willing to move. Did it again. But not intentional.
Not move. I think it does hit to one of my biggest pet peeves right now, though, is so much of what we call innovation and what fintechs are pursuing and banks are pursuing is really just the icing on the cake. They're not really getting even into the layers of the cake to fix the underlying fundamental issues, right? We're just stacking more and more.
Yeah, the plumbing.
Yeah, the plumbing needs to be fixed, right? A lot of it, but it's such a hard place to go fix because it does connect to so many different things. I wonder.
And understanding that mapping, understanding, how do you take this apart? And this is something that we've talked about off of a recorded podcast, but ultimately, where are the things that the banks will move on, and how do you go and find those problems and pain points, and then build solutions that are technically able to be integrated, but also can have a real effect. Throwing the scenario analysis in there with the bank where it's like running the same files through this modern core and seeing the efficiency being created. It's tricky though. You have to come with data, and that's why most companies that want to go to the enterprise try and solve these problems for fintechs first, because you have data and then you can use and lead with that. And that's something that will ultimately get you part of the way there, but you got to talk to your customers. No, like first and foremost, the banks don't need it, then you're right. It's probably just going to remain status quo.
I'm going to say here, I think one of the biggest promises of cryptocurrency and blockchain isn't that they actually replace these systems. They may or they may not. I'm not making that statement, but at least the threat of them, right? That they could be disruptive if the underlying systems don't get fixed on their own is causing a lot of people to wake up and go, oh, we have an infrastructure problem that maybe we should go address, rather than just complaining that Europe was able to do it and India was able to do it, but they had the advantage of they didn't have incumbent complexity, right? They were leaping ahead. Well, Africa is willing to do it for this. There's always an excuse. Well, there's kind of no excuse when there's an existential threat that might come disrupt you.
I've used that narrative in the past to believe that the existential threat will certainly get things going. But when the threat of losing your customers and not even able to acquire them or onboard them came to fruition, that's really what got things going. And I was talking to a bank corp prior to our conversation today around the types of banks that they work with and the pain points that they're seeing. And they said, overwhelmingly, they all came in, we're like, we need fintech, and here are all of our problems. But they didn't know how to prioritize them, actually. So that's a new challenge. And I just like data. So we're just chatting about how to figure out what do you stack rank as important. And I think checks is certainly one of them, just using $2 trillion on a quarterly basis in value of what was sent in the mail on a paper check. That's nuts.
Yes, absolutely. Well, you need to get back to your Peloton in the background there. And so thanks for taking a Friday to chat about the biggest fintech in the world.
Likewise.